Today, a Vertigo. Markets still grinding higher, just don't look down. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and property news. Well, this is our weekly market update. We start in the US, across to Europe and Asia, and in Australia, covering commodities and crypto along the way. Global stock markets rallied on Friday, with Wall Street crowning November with its biggest monthly gain in a year on post-election growth hopes, while the dollar eased amid prospects of firmer rates in Japan and easing in Europe. MSCI's broad gauge of world stocks rose 0.52%, securing the best month since May, up 3.63%. Europe's STOXX 600 share index rose 0.58% on the day and was up 0.96% across the month, recording its first monthly gain since August. Technology stocks were the biggest boost to the index, gaining 1.6%. Of course, US trading was thin the day after Thanksgiving. Many investors made a long weekend, and stocks and bonds closed early, so most month-end position adjustments were done before the holiday. The S&P 500 rose 0.56% to mark the best monthly gain since November 2023, as investors ploughed $141 billion into US equities, the heaviest inflows for a 4-week period on record. That's according to EPFR Global data. The US is currently an investor magnet. Nvidia and Apple helped pace the S&P 500 to its 53rd record closing high of 6,032.38. The Dow was up 0.42% on the day and 7.54% on the month, and the Nasdaq was 0.83% higher on Friday, and that's a 6.2% gain for the month. That's the best since May. The stars of the month, though, have been the small cap stocks, with the Russell 2000 index being very close to achieving the second 10% plus monthly return of 2024. This small cap index, often seen as a risk-on gauge, has broken through key resistance levels and reversed its underperformance trend versus a broader market. This rotation suggests increasing participation across sectors and a broadening of market strength, reinforcing the bullish market thesis. Seven's report's Tom Massey said despite very stretched US equity valuations, a grind higher into year-end remains entirely possible, if not likely. But there were conflicting signals out there. For example, the latest weekly survey from the American Association of Individual Investors showed that optimism about the outlook for US equities has eased for a second week, and bearish views have risen for 3 weeks in a row. Donald Trump's November 5th election victory and pledges of tax cuts, deregulation, import tariffs has supercharged investors' expectations for US and Wall Street stocks to keep outperforming other regions. US tech shares are also benefiting from an AI investor craze. Trump's import tariffs could boost US inflation, and Trump has pledged an immediate 25% tariff on all products from Mexico and Canada when he takes office in January, and an additional 10% on imports from China, a major trading partner for Asian economies, and Eurozone export powerhouse Germany. Federal Reserve officials have turned cautious on rate cuts, while futures traders have put odds that the Fed will cut rates another 25 basis points in December at 65%. However, for 2025, they see less chance that the central bank will continue to bring rates down at the same pace as this year. US data showed that the Personal Consumption Expenditures Price Index, that's the US Federal Reserve's preferred measure of underlying inflation, picked up in line with estimates. Another reading showed that the US economy expanded at a solid pace in the third quarter. And US President-elect Donald Trump threatened to impose trade tariffs on China, which could spark a renewed trade war between the world's biggest economies. But US semiconductor stocks rose after reports suggested that the Biden administration's anticipated export controls on China may be less stringent than initially feared. New restrictions are expected to focus on companies producing semiconductor manufacturing equipment rather than the broader chip fabrication sector. This softer approach includes fewer Huawei suppliers being added to the entity list and excludes major DRAM manufacturer CXMT from direct sanctions. Analysts see the developments as a relief rally for the oversold semiconductor sector. The yield on the benchmark US 10-year note fell to 4.177% as investors bought government bonds this week after Trump nominated hedge fund manager and Wall Street veteran Scott Bessent for Treasury Secretary, easing fears about excessive US borrowing. Focus on the coming week will be on comments from a slew of Fed officials, including Chair Jerome Powell on Wednesday, for more cues on interest rates. The New York Fed's estimate of the 10-year term premium, that's the additional compensation investors demand for holding longer-term debt to maturity, has actually dissipated now. It's about 13 basis points, almost a third of post-election peaks. The dollar index, which measures the currency against six major rivals, was up over the month, but fell 0.26% to 105.74 on the day and ended the week 1.4% lower, thanks to a sudden rebound for the euro, which has been lurching towards the key $1 marker on tariff fears and a bleak Eurozone outlook. While Americans have been feasting and preparing to shop, US Treasuries have put in a decent rally this week, countering considerable post-election fiscal anxieties as world bonds find a bid more broadly. While the holiday week and month-end position squaring may explain some of the peculiar substance in government yields, the move partly reverses at least one of the prevailing Trump trades. And in Canada, in Toronto, the TSX Composite rose 0.41% to hit a new high, and the VIX there was up 4.63% to 1107. In energy markets, crude prices ebbed on the tentative ceasefire between Israel and Hezbollah in Lebanon. US gasoline pump prices quietly ticked down to their lowest in more than 3 years. US crude fell 0.42% to $68.14 a barrel, and Brent fell to $72.30. The Middle East conflict has not disrupted supply, which is expected to be even more ample in 2025. The International Energy Agency sees the prospect of more than 1 million barrels per day of excess supply. That's equal to about 1% of global output. Gold rose 0.42% to $2,673.90 an ounce, having fallen 4% at the start of the week due to the ceasefire between Lebanon and Israel, but has since recovered around half of that fall. The price found support at $2,600 per troy ounce, which also provided support in late September and early October. Now, over in Europe, auto stocks were among the worst hit in November, knocked down by concerns that US President-elect Donald Trump's proposed tariffs on Mexico could be damaging for European car makers. It's actually more damaging potentially than any direct tariffs on EU goods. Defense stocks, on the other hand, gained the most among sectors, largely due to the Russia-Ukraine conflict. France's CAC 40 has been one of the worst performing exchanges in the region so far this month due to the country's political uncertainty. It was up on the week, but down over the month and the year. Prime Minister Barnier dropped plans to raise energy taxes in his 2025 budget, bowing to far-right pressure. The budget woes had pushed France's borrowing costs to match those of Greece for the first time on Thursday. The DAX in Germany was up more than 1% on Friday and is higher across the month and year, mirroring and outperforming the UK FTSE. Flash estimates from Eurostat revealed that Eurozone inflation climbed from 2% in October to 2.3% in November. That's surpassing the European Central Bank's 2% target. This figure did align with market expectations. French and German government debt yields both fell back on Friday, with the spread between the two narrowing as signs of some compromise emerging in the French budget row. The euro wrapped up the day up 0.21% at $1.0576. It has recovered from crushing losses since November the 5th's US election to gain 1.25% this week, supported by data on Friday showing that higher Eurozone inflation, limiting bets on deep European Central Bank rate cuts. Traders have fully priced in the 25 basis point European Central Bank cut to 3% in December, although hawkish remarks from board members this week has dampened speculation about a 50 basis point reduction. Goldman Sachs says it's forecasting continued growth in the euro area in 2025, but several factors have a significant potential drag on the economy. Anticipated tariffs imposed by the US President-elect Donald Trump, high energy prices, and competition from Chinese manufacturing are expected to weigh on the bloc. Our economists predict area-wide growth of 0.8% for 2025, notably below the consensus forecast of 1.2%. Even so, a euro area recession is unlikely, they said. Consumer spending in the bloc is expected to recover, given real rising incomes and elevated savings, and underlying inflation is declining. Goldman Sachs research expects headline and core inflation to return to 2% by the end of 2025. The UK economy, meanwhile, is forecast by Goldman to expand 1.2% in 2025, up from an estimate of 0.9% this year. The Bank of England, by the way, warned in their financial stability report that global risks associated with geopolitical tensions, global fragmentation, and pressures on sovereign debt levels remains material. Uncertainties abound, and risks to the economy have increased. As the UK is an open economy with a large financial sector, these risks are particularly relevant to UK financial stability, they said. Speculation about Japanese rate hikes drove a rebound for the yen that ended with the biggest weekly gain versus the US dollar since July. The dollar fell 1.18% on the day to 149.76 yen, under pressure after Japan's government finalized a stimulus budget and inflation in Tokyo came in hotter than economists had forecast. Tokyo's Nikkei 225 index ended November of 2.23%, even though Japan was not singled out as a tariff target. The TOPIX was also weaker and across the month too. MSCI's broadest index of Asia-Pacific shares outside of Japan showed a 2.35% loss for the month. The Bank of Japan governor said that the timing of the next interest rate hike was approaching as the economy was moving in line with the central bank's forecasts. That left the chance for a December rate cut increasing. However, he said that the Bank of Japan wanted to scrutinize developments in the US economy as there was a big question mark on its outlook, such as the fallout from President-elect Donald Trump's proposed tariff hikes. We can say it's approaching in the sense that economic data is on track to meet our forecasts, he said. And he emphasized that if the Japanese yen continued to depreciate after the country's inflation rate surpassed the anticipated 2% target, it could pose a potential threat to the central bank's economic projections and would warrant a response. Core inflation in Japan's capital accelerated in November as markets stepped up bets of that December rate hike. Traders now see a 60% chance of a rate hike next month, having been undecided before the data came out. Tech, though, is still in question, as Citi analysts warned that the initial tech rally reflected relief over fears of wider sanctions, but flagged longer-term concerns about lackluster growth in wafer fab equipment, the WFE sales. We believe the fundamental investor concern remains an uninspiring flat to up 2026 WFE setup, China flat to down again, assuming 20 to 25% China normalized equipment sales, and uncertainty around international HBM DRAM spend, said Citi. We remain defensive on the group. In China, the CSI 300 was up 1.14%, while the Shanghai Composite was up 0.93%, and the Hang Seng was also higher, but it was also lower across the month. The Kospi was down 1.95%, and the India Nifty 50 up 0.91%. The Australian share market edged low on Friday, pairing gains earlier in the week that pushed the exchange to set two record highs in the week. The benchmark ASX 200 fell 0.1% to 8,436.2 at the closing bell, with 7 of the 11 sectors in the red. The All Ords was flat. On a weekly basis, the benchmark notched a 0.5% gain. The step lower came after the index ended Thursday at a fresh record high of 8,444.3, having already set a record high earlier in the week on Monday. The benchmark record run on Thursday was led by gains in index heavyweight CSL, which fell back 1% to $282.22 on Friday, dragging the exchange lower. ASX property stocks were the worst performing sector, sliding 0.7%. Goodman Group shares dropped 0.8% to $37.91, and Westfield parent Centra was down 1.1% to $3.68. The falls come after economists from three Australian banks, ANZ, AMP and Bank of Queensland, pushed out their forecast for the first rate cut from the Reserve Bank of Australia to May from February previously. AMP chief economist Shane Oliver expects the RBA to remain flexible, meaning a February easing is still possible, but he noted that the hurdle to cut rates at that meeting looks high and would require a combination of very good December trimmed mean inflation readings and a sharp rise in unemployment in the next 3 monthly releases. This is possible, but not probable, and so we've pushed out our expectations for the first rate cut from February to May, Dr. Oliver said. In fact, Michelle Bullock, speaking at CEDA this week, was frankly bullish, again reiterating no rate cuts until the path of inflation is definitively heading towards the 2% target. A monthly data this last week again showed that we are ways away from that. The prospect of a new interest rate setting board at the RBA by March also has added to uncertainty around rate decisions, as new board members will potentially alter how the central bank reacts to data. The money market has only a 30% probability of a February cut, but has one fully priced in by May. By the way, the banks are still well overvalued, with CPA at $158.58 and Westpac at $33.36. Star Entertainment shares briefly slipped 3% to 18 cents, a record low for the embattled casino operator, following a downgrade to an underperformed rating from analysts at Macquarie. That's after shares fell 7.1% in yesterday's session, after reporting an earnings loss of $27 million in the first 4 months of the new financial year, as the casino operator continues to scramble to shore up its finances. Shares recovered late on Friday to end the session unchanged. The eruption of a global trade war under returning US President Donald Trump could plunge the Aussie dollar below 60 US cents, particularly if China responds to higher tariffs by allowing its own currency to weaken. That's according to National Australian Bank. The Aussie sank to a 4-month low of 64.32 cents this week after Trump flagged his intention to impose a 25% tariff on all products from Mexico and Canada and an additional 10% on goods from China. He cited concerns over illegal immigration and the trade of illicit drugs, particularly fentanyl, a deadly synthetic opioid, as reasons for the levies. While financial markets need to speculate on whether Trump will follow through with his pre-election threat of a 60% tariff on Chinese imports, strategists warn that economic growth outside the US will be hit regardless of the severity of tariffs. The Aussie was last at 65.12 US cents and 51.14 UK pence. In cryptocurrencies, Bitcoin briefly traded above 98,000 US, but was last at 96,534. Despite disappointing investors and traders because it has yet to climb past the anticipated 100,000 level, it rose about 37% across November. That's the fourth best month for Bitcoin in terms of price performance since October 2021. This month's performance was surpassed only by a 44% growth in February 2024 and a 40% rise in January 2023 and October 2021. This was linked to various macroeconomic factors, including rate cuts. Meanwhile, the expiration of Bitcoin's options contracts, worth about $9.4 billion, has also nudged the coin up a bit in the market, but Bitcoin market volume has dropped considerably by around 34.48% to 47.1 billion US. This metric signals investors have remained cautious about the coin's ability to cross the 100,000 level this cycle. Regardless of the current price level, some are predicting significant growth is possible through the remaining days of 2024, maybe to hit 200,000 US. Well, this is, of course, the point. Markets can hope, but Bitcoin and the markets more widely continue to be driven by, well, hopium. Just don't look down. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.